Silver is in an acceleration mode. It's not in a normal uptrend mode. So if one applies the normal technical metrics that say overbought, for example, ignore them. We're not in a normal market. A normal market meaning a normal bull market, that goes up in layers, or a trading range market that gets excesses both ways. Silver is in a seeking a new reality market, is what the phrase we use. It's going into a new reality, and it's going to do it suddenly. Meaning, by our metrics, not judging the silver by its own dynamics, but the silver versus gold situation, which a lot of people plot the other way, the ratio. We divide silver into gold and express the answer as a percent. And back early this year, it was down to 1%.
Michael Oliver says silver has entered acceleration mode, where overbought signals don't matter. After breaking a 50-year range, he targets $200 in 6 months, possibly overshooting to $500. Gold, only 4 times up so far, could far exceed $8,000 as money printing accelerates. Thanks for watching. Give a thumbs up and subscribe to Fine Metals for the latest insights.
We're in a bull market now. We've broken out on the spread. So I don't think we're just going to 2%, which is, who cares? That's normal. But we're at least going to match the old spread highs of those prior bull markets. Heck, we've taken out the price highs of those markets. Why not the ratio highs? And I think we will. My minimum assumption, and this is now minimum, is that silver will at least see 200 in the next 6 months. Okay? Now that sounds crazy. Well, again, when you look at that copper chart, it went from like a range from 50 cents to $1.50, and all of a sudden went up to 4.50 in a couple quarters, and it was unique to copper. These kind of things happen. And I could have found 6 other markets that did the same thing over the past 50 years. Silver's doing its thing now. And we all know that this time around it has unique factors that are underlying this, but most people forget the real factor, silver ounce versus an ounce of gold, which if you go back 50 years, you see times when it's that low, you buy it because it's too low in relation to gold. In the 1979 to 80 move, which everybody remembers, that's when silver went actually from, it had been in a low around $3 or $4 and went to 50 over a couple years. A lot of that compressed in the last couple quarters. In fact, a 4-fold increase in the final 2 quarters of that move. And in 2001 through 2011, there was another bull market, but a lot of it was compressed in a couple quarters in September 2010 through April 2011, where several doubled in a half in 5 months. Okay. But those were within that old range of reality. It's half a century of this. Okay. You've got some charts if you want to show them, but there have been other markets that over history, rare events, admittedly, but have been stuck in price ranges. Copper's one, lead's another we've shown to our subscribers. Back in, this is just a good historical example. Copper was stuck in a range like silver between the 1970s, 80s, 90s, 2000, and 2005. The top of that range was about $1.50. Okay. And it suddenly decided, for whatever reason, unique to itself, because it did it on its own. It was not coincident with gold. It was not coincident with other base metals. Copper quadrupled in a couple quarters. And then subsequent to that, it overshot, it's no new normality, but it moved out of the old multi-decade range and did it like bam, not in an incremental layered manner. Lead did the same thing in 2007. It had been in like a 40-year range, and it said, oh, okay, I shouldn't have been here that long. I'm priced too low relative to, let's say, degradation of the money unit. So it did the same thing. It quadrupled in a couple quarters in 2007, and then subsequently lived in a new price reality that was roughly 4 times the price level of that average old price reality. And when it broke out, that was the November close. And silver then was what, at 44, you said something like that? Yeah, where we last talked. Okay. Well, look what happened since. The month of December, you went, well, I think the November price close was in the mid 50s. So we gained, 10, 20, 30% in a matter of 4 weeks. What caused that? The spread broke out. And when you go back and look at that 79 explosion to 1980, silver's been in that reality for 50 years. Why didn't silver coincident with copper in 2007 or 2005, or lead in 2007, or gold in its repeated eightfold bull markets, goes well past the old high. And yet silver stays in the box. What's going on there? Well, there's arguments that, it's been artificially restrained and so forth. But forgetting that, when a market decides to say, hey, I made a mistake, it quite often will compensate for the mistake by repricing itself rapidly. This is true with like bull market bubble tops, like in the stock market. Sometimes it crashes, okay? It compensates for it and overdoes it. Well, silver's saying, hey, I'm out of here. And the momentum already said that back in June. We said, okay, when silver was coming up toward that mid $30 level, it'd been 35 and 35 in 2024 and 2025 early. And silver could drop down under 30 again, and it's coming back up in June of this year. And it was in the mid 30s, and we said, oh, this time it's different. You're going to accelerate. And that was a momentum based assessment, not just that price looked good. And sure enough, it zoomed past 35 and got up, up toward the old range highs, the $50 stuff. And now we've since blown that out. But its mode of advancement has accelerated, like you noted, the year to date. And we now have demand for silver that is outpacing supply based on high-tech things, solar power for the solar panels, and also all the tech and AI constructions that are going on. Silver is essential in that. It's embedded in everything you touch, okay? Maybe a small amount, but it's an essential. And that demand is eating up the supply, and supply is not increasing despite the higher price. So you got a unique situation there just on that industrial aspect of silver. But the underlying reality is it's money. Don't forget that. It's poor man's gold. And it's going to catch up to gold. It's going to catch up to its old relationships to gold. And in the process, that's an incredible price implication. And I think it may even challenge the spread highs we saw in 1979, 80, 6%. Again, we're 1.6 right now, okay? And take out the 2011 peak, which was 3.1, I think. So those are factors that are underlying. So silver's like a surfer riding on waves. And the top wave, everybody chatters about. It's just the day-to-day, they raise margins on the COMEX or this, that, or the other, all micro stuff that doesn't matter. It's the ongoing supply demand, not whether the COMEX raised margins by 5, 10%, 5, 10%, 5, 10%. That's not important. The fundamentals are still there. And then you've got the monetary factor. If you go back and study silver on a logarithmic scale, not just a price chart, and gold on a logarithmic or ratio scale, and you go back to 75 when they legalized it, okay? Gold had a corrective low in 76 down near $100, 103 actually. In fact, I was standing next to the pit the day that occurred. It was in August of 73 in the COMEX. It went from $103 to $850 in 3.5 years. That's an eightfold move. Okay. And under conditions that are nowhere comparable to what's underlying the market right now in terms of massive monetary fundamentals. Then in 2011, after a 10-year run up, it had an eightfold move from $260 to $1,920. Eightfold. Oh, interesting. Okay. Now we're fourfold. Our bear market low was in 2015 at $1,050. We've gained fourfold. Okay. Yet the underlying conditions are far more serious and yet to be unveiled fully. Some people realize them. And if gold merely goes to I did it again, another eightfold move, you'd be 8,000 plus. And even that's no big deal. So I throw that number out a lot, not because I'm predicting it. I think it's a nonsense number. You're going to get there and go way beyond it, especially when these underlying monetary factors become more bleeding obvious to the analysts and investors who are apparently oblivious to these factors. Uh, so 8,000 would be, so what? We did it twice before. I think gold could go way beyond that. So when you express the ratio of silver to gold or our percent scale of silver to gold, and you go to, 3% of 8,000 gold, well, you put the number on it. But what if you go to 6% of 8,000 gold? Whoa. And what if gold doesn't stop at 8,000? Whoa. And plus, you did the monetary factor there of M2. Okay. That's very interesting because it says, yeah, 200, I just matched the 1980 high. Well, when markets go from excess one way, in this case, is silver suppressed for too long, and goes to a new reality, it'll usually overshoot what should be that new reality. It overdoes itself. This is typical of market moves. So, it wouldn't shock me that if 200 is back to the 80 high, well, maybe you go to 500 before you settle back at 2 to 300. Okay, you get the point? So, and a lot of it because of our spread analysis, which I think is the key factor now. And also, there's some other spreads that need to be looked at that just began. And those are the asset class breakouts where gold versus the US stock market measured against the NASDAQ 100 or the S&P just blew through an 11-year wide spread base where it lived in a range up and down versus the S&P where gold would rally versus the S&P and then pull back. But net on balance for 10, 11 years, gold was par to the S&P. That is an intellectual honor statement the guy made. I mean, to break the old orthodoxy and at least admit that real money should be part of your assets. His ratio is wrong, but that's fine. The fact that he admitted that it should be a large component of a normal portfolio is a great statement. And it's an admission on his part that something's wrong. Okay. And, Jamie Dimon, has said a couple months ago, we can't keep doing this government debt problem in relation to GDP. You can't keep playing that game. Finally, you're going to run to a point where you got a crisis. And I'm thinking when you look at the T-bonds, which anybody in gold now should be focused on, because that T-bond market, if it cracks, and the recent buying of it only has stabilized it, and it somehow cracks through the structural supports we see on momentum, that could cause a mini panic, and you can't take that. If that yield chart pops through that shield, that ceiling of highs we've had for the last 3 years, people are going to say they're going to pull their hair out. And all kinds of assumptions based on stability will go out the window, including stock market or especially commercial real estate debt. We know commercial real estate is up to here, and they can't. It's long dated debt. They can't take that. The Fed knows it. They don't want to talk about it specifically, but that's the kind of sideline ambush that could really undercut all kinds of assumptions, hopes, and generate fears, which creates change. So the shift that we've seen in the spread relation between real money and the stock market, which just broke out in October, gold or silver even broke out versus the stock market, or gold miners broke out. It's saying something. It says some money's moving over there enough to break out of a massive decade-wide base